All right, Wilson. Well, welcome to the show.
Oh, thanks. Great to be here.
Don't forget to say our ads first.
Oh, yeah. This is sponsored by Budweiser, Jameson's, all alcohol. This is sponsored by booze in general.
Yeah, it's great timing.
Oh, yeah, it's St. Patty's today.
Yeah.
Are you going out today?
Might as well. 3
Yeah.
days in a row.
Yeah.
Why not?
Pollute the body somewhere?
Oh, yeah.
Yeah, Wilson and I just are coming off a long night last night. Separately, but both long nights.
Yeah.
So we'll try and get the brain running here.
He was at a house.
And this might skip the orders.
And not by himself,
Just-
we concluded. So anyways, I invest myself
Mm-hmm.
in very boring, low-risk ETFs.
Yeah.
But you do more interesting stuff. So what are you buying these days, and what kind of stocks have you been researching for a while? Because I know you've been in a certain field for...
Yeah, so, well, it's like, 2019 now, and I think back in 2014, I guess, it would be like late 2013, but like I started, I was more in, a bunch of different stuff, right, like technology and, biotech and telecom or whatever, right? Really had no clue what I was doing. And, as luck would have it, and like, the biotech investments did better than most of the others. I'm like, oh, this tends to make me more money than how many other losers. So like, I'll kind of look more into that. And then,
One black amongst all the reds.
yeah. And then, and so I started off with like, there's the large cap companies, right? Because I kind of knew enough about financial analysis and at the point where the large cap companies typically have, products approved. So you can see the income statements and the, balance sheets and whatnot, right?
Yeah.
So based on that, like I had a decent idea what companies like were undervalued and whatnot. So I did that for until for 2014. The problem with that though is that there's only you can count those companies on two hands, right?
Right.
And they're not, even though they're large companies, they're not inherently that diversified. One
Okay.
of them will have they pretty much just do cystic fibrosis. Another one would just do HIV or multiple sclerosis kind of thing, right?
Right, okay.
So that kind of forces you inherently to kind of learn more small and mid cap companies, and obviously the risk there is much higher because these companies, they're bleeding money. They don't have approved products, obviously. Usually, I guess. Even if they do, typically the operating expenses are way exceeding, the revenue, right?
Right.
You have to keep in mind with the competition, and especially if it's a late stage clinical trial, then you have to learn about statistics and clinical trial design. So I started doing that, and obviously making mistakes here and there, but every time I'm like, oh, I could have, if I saw this coming, then I would. I'll remember for next time, I guess, right?
Right. Okay. So what are you looking for here?
Yes.
There's these key markers in a company's sort of development to becoming quite profitable. What are these markers you're looking for?
Yeah, so that's a good point. And actually, it was interesting because I saw this thread on Twitter just the other day, and the guy was saying you should be able to explain an investment strategy very simply, right?
Right.
So I'm gonna try to do that here.
Yeah, that would be great.
Yeah. So because I like even though the large caps are haven't really done that well over the last 5 years, I think on average they've compounded at about 5%.
So large caps for biotech?
Yeah.
Okay, specifically we're all talking biotech.
Yeah, there's
okay.
I should probably I've only done biotech since
Okay, so, yeah.
2013. Yeah. And honestly, I don't know if I'd ever be able to do another industry after biotech.
Right. Okay.
Just because I've put in so much time, and if for some reason biotech just completely collapses, I'm just going to ETF. I'm done.
Okay.
Doing more.
Do
right?
the safe route, like what I do.
Yeah, and ETFs are great.
Okay. Sorry. Go ahead.
But anyways, yeah. So as I was saying, maybe I think maybe 35% of my portfolio is in large cap companies.
Right.
And yeah, and the rest, and I think there's maybe 37 companies across the remaining 65% of my portfolio, and maybe 4% of that is micro cap, so under 600 million market cap.
Right.
And those are the ones that are you're going for the Hail Mary kind of thing, right?
Yeah.
Or the Grand Slam.
But you said 60%. Or how much?
So the breakdown would be about 34% large cap.
Okay.
like I think about 46% mid cap, so that's about between like 13 billion and like 3 billion roughly.
Okay.
Like I know like 19% small cap,
Okay.
and 4% micro cap. I don't know if those percentages add up. I'm just
Yeah.
just kind of throwing that out there.
Right. Okay.
It should be
okay.
close to 100%.
So if you had so you're, if you wanted to build a biotech portfolio, these are the
Yeah, but
these are the percentages
that's
you
just
generally go with.
well, that's just like my strategy, right? Because
Right.
like I had this theory back in 2014. I'm like, well, large cap companies, they're like, I think the thing with large cap, even though they make a lot of money, management, the quality of management is a huge factor, because if they make one bad acquisition, or they, it can just be disastrous for the company, right?
Right.
So for large cap companies, it's very, I'd say, manager centric. And then with small and mid cap companies, and this is where my opinion kind of more differs more than other people. A lot of people think management is everything. To a degree, like they're right. But I think for the small and mid cap companies, the quality of the clinical assets usually is the key driving factor.
Okay.
So I guess, as I was saying before, like with these small and mid cap companies, I'm generally really looking for what I consider to be high quality clinical assets that are likely to pass their phase 3 trials, or the pivotal trials, or they already have, they're in a field where there's no competition, and if there is competition, that they, the profile of their drug is superior enough that I believe that they will, do well commercially against whoever they're competing against.
Right. Okay.
So you're just pretty much you're just pretty much stacking the odds in your favor.
Right.
Like I don't expect like all of them to work out. Like some of them will definitely fail disastrously, and they have in the past. But
Right.
Overall, like theoretically, like the good ones should outweigh the bad ones by a pretty big margin.
Right.
They have so.
Right. So for large cap companies, you're
Yep.
looking for great management. And
Yeah.
then for the mid to small
Well,
cap,
it's not even like great management. It's just basically like acceptable. Like our standards.
so basically, are they keeping the ship running well?
Yeah.
And then small to mid cap, you're looking at basically the actual product and saying
like the
is
quality of asset, and then like with respect to like the valuation as well, right?
Okay.
Because
Okay.
like if it's a great asset, but like I think the company's too expensive, then maybe you wait a bit longer.
Right, because it's already overvalued or something like
Yeah,
that.
and another thing is like it's just a portfolio strategy. Like so I might see a company that I like, but just because like it might not necessarily fit into like my strategy, I just won't take it on, right?
Right.
So when people are like, oh, like why don't you have this company in your portfolio? I'm like, well, that's a pretty ridiculous question. I'm like, well, I don't have Apple in my portfolio, or like Amazon, like
It just doesn't fit.
yeah, like and like I'm already like I have like 44 positions. I know them pretty well, and that's not to mention all the ones I'm like, oh, those look okay, but and then the ones I'm like, these are all trash, right? I probably looked at like hundreds of companies, and
Right,
so, like,
right.
there's only so much like I want to do as like just me, I guess. So
Right.
yeah, I do value my time. So
Okay, fair enough. So what is it, buy and hold? Like long?
yeah, it's buy and hold. Like so the small and mid cap companies, like I almost always just take the position once, and I just let it go. And to be fair, there'll be some times where I think I will sell it because like circumstances come up that I think the company is perpetually has risk of being terminally overvalued.
Right.
So kind of an example is this one company, Tessero, back in I think 2017, it was up to like $180 a share, 190, which is probably like a $9 billion valuation. And then a competitor company, Clovis, they which has pretty much a drug in the same class, right? They released pivotal trial results, and the drug was basically better and safer, or it was equal but safer. And I was like, I don't think Tessero can maintain this $8 billion valuation like ever.
Right.
So like that was the point where I completely sold my position, and actually went down all the way to like $19 a share,
Holy.
and then it got bottled for 75.
Wow.
Yeah, but I sold my last shares there like 130 or so.
Oh, okay.
Another example is like this company called Acadia, and they were up to like I think $38 a share, which is something like $4 billion, and they have this their drug is already marketed, but they're also trying it in like dementia related psychosis.
Right.
And I don't think the trial's going to pass. Like I think it's going to bomb like
Oh.
disastrously. And I was like, just based on like their sales and stuff, like I don't think it'll ever go back to $4 billion. So I sold it, and now I think it's maybe like a 30 or $28 a share, so a bit down. But like I reinvested those profits into companies that I thought were much better, and those ones have done much better. They're actually up. So
okay.
Yeah.
So you made the good call there in both cases.
Yeah. So that's with the small and mid caps. But generally, I just let them fly. And the large caps, I might tend to trade a bit more because I'm more confident in trading those because, again, you have the cash flows, underpinning the valuation, right? So every time there's like a bear market, which is fairly frequent, like pretty much every year you'll have one.
Like in biotech
specifically? Yeah, it's extremely volatile. Like 2014,
ask.
2015, 2016, 2018, there's been a 20% drop from the peak at any given point, and people lose their minds when this happens.
Yeah.
Which I don't really get because you think you'd be pretty used to it by now.
Right. So it's a pretty volatile genre.
Yeah, but like every time I'm like, well, there's like these like 7 large cap companies, in which based on what they're trading at any given time, which ones am I more likely to allocate money to first, right?
Right.
And then if there's anything left over, like I'll start maybe I might put money into like small and mid caps, but by that time the bear market is probably already corrected and things are back to normal, I guess. So
yeah, fair enough. So how do you actually know which products are going to do well or not do well, like specifically? Because you're talking about trials and you're talking about like competitiveness between different new products, right?
Yeah.
How do you know, or how do you understand the differences?
Yeah, so that's a good question. Like, I think if you're kind of like, well, I guess if I were to ask you, like, what if, I know you probably don't follow biotech that closely, but if you were to kind of invest in a company, like, what do you think you would look for, I guess?
Me personally?
Yeah, just kind of.
Well, I think great products. I know that sounds really sort of lame, but when I used to trade Apple back and forth a bit, a lot of it was around the release cycles.
Yeah,
it was
like
around
quality,
their
right?
products. Yeah. So but in that case, it was product based.
Yeah. And I guess biotech is not that much different, right? Like, I guess you want to keep in mind the competition. So I guess a lot of my stuff is in like oncology and like hematology and rare diseases, right?
Right.
Because there tends to be less, especially in rare diseases. Obviously, there tends to be less competition.
Right.
And actually, we'll start there because if you have a effective monopoly over any particular like rare, ultra rare disease, then you generally have it. And these clinical trials for these types of drugs they're all pretty unique because they're ultra rare diseases, but you generally have a good idea if the drug's going to pass just on proof of concept, and generally the FDA is pretty lenient with those indications as well.
Right.
And then after that, like after you get approved, you just kind of watch the launch cycle, right, and see how the revenues are ramping up, how that offsets operating expenses, because especially with the small and mid caps, like once they go commercial, operating expenses go like way up, right?
Yeah.
And that's a very big misconception about the small and mid cap space. People think like, oh, once your drug has been approved, it's like all smooth sailing.
Yeah, that would be my perception.
Which is actually like, I'd say usually more wrong than correct. Like a lot of drugs, especially if they have a bad competitive profile,
right?
Like the companies will spend so much more on SG&A, right, selling, general, administrative, and the expenses will ramp up, and they'll lose money more quickly than they were before the drugs are approved, right? And a lot of companies, especially if they have like debt and they have bad covenants attached to their debt, like they don't recover from that.
See, my perception would always be that that's the golden ticket, is the approval of whatever drug they're working on.
And some people, like, they're based on their trading style, they'll, once the drug's approved, they'll sell it, right?
Yeah.
But since I'm interested in kind of going through like late stage, through the launch and do the well into the commercial process, like even when I'm taking a company or thinking of buying a company in mid stage or late stage, I'm already looking like 5 years ahead, right? Or 10 years, like how would this look 3 years after it's approved, right?
Right.
You can't look like infinitely into the future because these drugs do go off patent, and after that, who knows? But it's like 15 years down the road, and you can definitely readjust your thinking way before that happens. So
So when it specifically gets down to the products themselves, like, did you spend time researching the medical field, like what's required, and like how do you know?
Yeah, exactly. So if it's something like like a non-Hodgkin's lymphoma, right? Which is a very or like diffuse large B-cell lymphoma, which are very aggressive and I guess lethal. I guess blood cancers, right?
Right.
You have to like look into the competition. What's the first line of treatment? So that's when patients are first diagnosed. Like, what are they taking, right? And then after they relapse on that, what are they most likely to take? And then after they relapse on that,
right.
For example, like a CLL, like chronic lymphocytic leukemia. Like the first line would be this BTK inhibitor called Imbruvica, and basically no company should ever try. Like, it's gonna be very challenging to develop a drug for first line CLL because like the efficacy of that drug is extremely high.
Right.
So it's a very risky business proposition. Companies know this, so they don't try to do it. But if a company did try to do that, you'd be like, okay, this probably pretty iffy, right?
Right. Okay. So that
Yeah, and then the next line would be venetoclax. Same thing, right? Very, very high efficacy drug. So that's like the kind of the second line. And then after that, you might start doing like CAR T, and some other companies are developing another BTK inhibitor to cover people that relapse from Imbruvica. But that's kind of the idea of it. And it's the same thing with any other kind of disease, or especially cancer, because cancer, talking about first, second, third line, relapse, all that stuff. But
right.
Generally speaking, you want drugs that are in the earlier lines because those are you're treating more patients basically.
Right. Okay. So that's when you consider when you look at products.
Yeah. And actually, like, it's interesting because like if I were to ask you like which cancer indication is the most profitable one, would you care to venture a guess?
Which cancer indication is the most profitable one?
Yeah. The largest market, basically.
So what do you mean by cancer indication?
Or so like breast cancer, lung cancer.
Oh, so which cancers?
Yeah.
And its corresponding treatment is the most profitable?
Just because of the size of the market.
I have no idea. Breast cancer, melanoma.
Yeah, those are pretty good guesses. It'd be lung cancer, though.
Oh, lung cancer.
Yeah,
okay.
so lung cancer.
Those smoking ads haven't been helping.
No.
People still smoking, eh?
No.
It's lung cancer.
Yeah.
So
by like a massive margin too.
So it's the most diagnosed cancer, or is it just some reason
well,
why
it's first of all, it's a very lethal cancer.
Right.
But like, so I think it's a most highly, I think, diagnosed cancer to begin with.
Okay.
And then obviously breast and I think prostate leg behind it. But compared to breast and prostate, it's much more lethal, right?
Right.
Because technically, or usually by the time they've diagnosed it, it's already kind of spread.
Okay.
So that's the thing with like all these kind of really low survival rate cancers, right? Like pancreatic and gastric system cancer and glioblastoma, brain cancer, and liver cancer. I guess that's usually the problem. Like by the time they've diagnosed it, it's already spread, right?
Right.
So that's what the threat comes in. So again, when you have lung cancer, when you have a really, people are like in very, very urgent care of need, and the prevalence rate is so high, you have a massive market for that.
Okay, interesting.
And it's interesting because there are a lot of, you can use like the leading drug for that right now is like Keytruda, right? It's a immunotherapy. You combine it with chemo, and actually they reduce like progression, or they increase the progression-free survival compared to just chemo by like double, right?
Right.
Or something like that. So like it was a really big accomplishment in cancer treatment. But you also get all these like mutations, right?
Right.
Like EGFR, ALK, all this stuff. So then you have some small mid-cap companies developing drugs to treat like only these mutations, right?
Specifically mutations
of
lung
cancer.
Mutations,
right?
Of lung cancer.
It could be.
Okay, could be.
But just generally the mutations, right?
Okay.
And it's interesting because it's like, if you think about it, they're going for very small pieces of a very large pie, right?
Yeah. And
those companies, generally speaking, or actually, almost across the board, have done extremely well.
Well.
Yeah, like they've been, Igainta was trading at like, I think it was like $5 a share, got bought at 27. I bought it at like a 17 or so, but that was still pretty good. And I think Loxo Oncology, which is like one of my favorite companies of all time, like I bought them at like I think like $23 a share back in October 2017. And that was their whole strategy, right? They're targeting they weren't targeting actual indications. They're just targeting this any type of tumor with this mutation, right?
Right.
And they got bought just earlier this year by Eli Lilly for something like $8 billion. So that ended up being $235 a share.
Wow.
So the people that got in the IPO, I think they made something like 1,700% or something ridiculous.
Oh, interesting.
Yeah.
So why is it so profitable to go for these, like, it seems like it's a small piece of the pie, these mutations?
Yeah, but like think about it. If you're targeting like maybe 2% of a market that's like $15 billion, that's still a substantial amount of money, right?
Right, and that's where you're going back to the size of like the lung cancer market. You can still take a slice of that.
Yeah, like it's like basically supply and demand, right? And in medicine, it's like epidemiology, right? The study of incidence and prevalence, because you have to know what the demand is essentially, right?
Before, like, for your company to
yeah
prevail, like, you're gonna do those studies, right?
Yeah, and like and it's actually interesting because like now you have all these things called like gene therapies, right? And I'm not sure how familiar with that, but basically, you have people with like monogenic diseases, so a mutation or like an issue with one gene essentially, and they're just using gene therapies to kind of fix that gene, right?
Mm-hmm.
But typically these diseases are like very rare,
right?
So now you have all these companies like doing gene therapy trials in lysosomal, like just storage disorders, right?
Mm-hmm.
And that's kind of interesting because like everyone's trying to get into like this area, but it's like a very small area to begin with.
Right.
So that's something I probably would not be very bullish on.
Right.
It's
right.
like it's I think it's a very bad business sense.
Too competitive, and there's too small of a market there.
Yeah, exactly. And like the competitive risks are just like they just go like way off the charts, right?
Right. Right.
So that type of stuff, like, and so I try to avoid competition, generally speaking, but like occasionally you have these like big markets like hemophilia, right? Hemophilia is like a massive market.
What is hemophilia?
It's just Johnny for like boys, but they just basically like their blood doesn't clot, right?
Oh, okay.
Yeah,
wow.
just due to a missing factor, I guess. Yeah, and it's a big market actually.
Really? Okay.
Yeah, so that's a one where I might be more confident spreading my bets, and I actually did with that one. Like I had one company called Unicure and they're doing gene therapy for hemophilia B, and I really like that one. And I had another company called Spark Therapeutics, and that one like they had 2 treatments for hemophilia A and hemophilia B, but both of them were like they're okay, right? I'd say they were behind the leaders,
right?
But I'm like, well, just based on this overarching platform, they also had gene therapy approved for like a retinal disorder, basically. I'm like, I'll buy shares of this one, even though I didn't think the company was that good, but like it's still worth diversifying.
Right.
And that one actually just got bought out like a month ago for, I think it was like $4 billion or something.
Right.
So I doubled my money on that one too, which is pretty good.
Nice. Is that the ultimate rush?
Yeah, I guess you kind of get used to it. But so that's like a hemophilia, and then like the leading company in hemophilia A would be probably BioMarin, right? But that's like a more large cap company. That's like a $14 billion, $15 billion. So you want all your bases covered, basically.
Right. So you're throwing out a lot of huge, big medical words I've never heard before. So did you read, like, did you do your research in medicine a bit to like?
Yeah, I have to kind of know what they're talking about, and I guess like that's and you have to kind of be familiar enough to make it work with your strategy, right? So obviously, where I would not be as good is like anything kind of early stage, when they're doing like the hardcore science stuff.
Yeah, exactly.
Like then I don't know, right? Like a lot of people like they're PhDs and they're MDs, right? So they'll understand like all this crazy testing a lot more. I generally when they're talking about on Twitter, like I don't really have an idea what they're talking about.
Yeah, because when I was asking before about products, I was thinking about scenarios like that.
Yeah.
Where like how far into the science and medicine do you have to get into? And it seems like in those scenarios you might not be knowledgeable enough to understand. Like at the very early on.
Yeah.
Testing or whatever clinical trials of a certain product. That's like.
Yeah, so I'm generally pretty like most of my companies are like late stage companies, right?
Okay, fair enough.
So I've seen the proof of concept data, and I'm like, oh, this drug probably will work based on the clinical trial design.
Right.
Right. But anything earlier stage than that, like their investors there are much better at that. Right. I'll let them run with it, I guess.
So there's definitely a barrier to entry for this area of the market, right?
Yeah, like, I'd say it's like...
Or can you invest basically specifically on metrics, like in the biomedicine?
Yeah, like, so like if you're just doing financial metrics, I guess, as I was saying before, it would be very difficult just because the companies that are profitable and like have real cash flow, you're pretty much looking at big pharma and large biotech, right?
Right.
Like, there's probably less than 15 companies that would fit into that profile.
Right. Okay.
So it's just inherently very hard just based on that.
Okay.
You can do it, but
so there's a barrier entry of having some.
Yeah, but every portfolio would basically look the same.
Right. Yeah. So right. Okay. So there's a barrier of entry there to at least understand some elements of the products and the medicine behind it and what needs to be treated and all the stuff you mentioned before.
Yep.
So there's that barrier. Okay. So, and you've been investing in biotech for like 5 years now, I guess, something like that, right?
Yeah, I think it was like by like 2014, my portfolio was like majority of biotech. Mm-hmm. And I think by like early 2015, like everything was solely biotech.
Right. So. Okay. So what does the future hold? Is it well, that's always the crystal ball question, but is that an industry that will just keep developing, or is there barriers there for the industry?
Yeah, that's an interesting question because there's it's the technology is advancing just so quickly.
Yeah,
right?
Exactly.
And gene therapy, everyone's rushing to gene therapy, and now it's like gene editing, right? You've heard like CRISPR and stuff, right? Yeah. I think they're starting their first clinical trials, pretty shortly here. But there's so much like competitive overlap that once something goes in, like if there's no real barrier to entry with that technology, like tons of people try to get in. So it's good for the patient, don't get me wrong. So like the technology will always like gene therapy, gene editing, those are like the big ones for the future. But from an investment perspective, I don't know if I would overweight gene therapies, I guess.
Right.
In my portfolio, right? Because of everyone's kind of expecting that and elevating the valuations, they get pretty ridiculous.
Right. So you're saying that's going to be the future from a medical point of view.
Yep.
Like we'll definitely have a lot of progress patient-wise, but you're saying investment-wise, maybe it's getting overvaluated already.
Yeah, I think from a perspective of a long-term focused biotech investor, you can't be chasing whatever like the big hype thing is. You have to be just looking at a very simple methods, like based on this and based on the epidemiology, the prevalence, and the competition. Is my investment likely to make money in the future? Right. That's really all there is to it. And then you're sizing your company based on sizing the position in your portfolio based on where you perceive the risk to be in your risk tolerance, right?
Right.
And like for me, like I have some companies before early or before mid-stage clinical trials, and I'll never put more than 1% of my portfolio into that, right?
Right.
And for anything with a late-stage clinical or early commercial launch, I'm willing to expose like max like maybe 2% drawdown, right?
Right.
So if the clinical trial fails, I don't want my portfolio to drop more than 2%, right?
Right.
And based on, so if you have a company estimate that based on their valuation that if they fail this trial they'll drop 70%, you can size your position based on that, right?
Right.
It's just simple arithmetic, really.
Right. Okay.
And the large cap companies, I'm more willing to take larger positions just because, again, they have those cash flows where their valuations should be more stable.
Right. So if I were to build a biotech portfolio today, would you still recommend the same positions and pieces of your portfolio as you do now, like 30%?
Yeah, so like
large cap and
so it's very important to point out that like that's just a strategy that I think works for me based on my risk tolerance,
right?
And based on because if I really wanted to kind of just try to maximize my profits instead of having 44 positions, I could easily cut it down to like 15, 20 easily.
Yeah, that seems like a lot, but I'm not a big investor, so I don't know if that is a lot of positions.
For an individual investor, it's quite a lot.
Okay.
If you're like a hedge funds, maybe they're probably pushing 50 positions, 100 position kind of thing.
Right.
For a typical, $1 billion hedge fund, I guess.
Right.
Sorry, I lost my train of thought. Yeah, like if I wanted to concentrate on like my top 10, 15 ideas, I could.
Right.
But I wouldn't be able to sleep well at night, right?
Right.
And like I tell people like I can even like equate everything. So instead of having these different weightings, I could just have 100 divided by 44, whatever that is, like 2 point something, right? 2 point something percent position in every company I own. But again, I wouldn't be able to sleep well because like some of those positions are like extremely high risk.
Right.
And like I'm not risking like 2% for that kind of thing.
So what's the sort of overall risk of the portfolio you just mentioned? Like, is it fairly risky? Like,
Yeah.
What is your risk?
For in the context of just any kind of equity.
Yeah.
It's very high risk.
It seems like it. Yeah.
Yeah. In the context of like biotech investors, it's actually very conservative.
Oh, okay. So that's a good thing to point out.
Yeah.
Right? Like as far as general trading.
Oh, it's for sure. Like
it's high risk. Okay, yeah. Fair enough. You're not buying like the 5% year-over-year ETFs. Like, no. This is way different than that.
Yeah, and like the large cap companies, a lot of people won't even bother the large cap companies, right? Because they think they're growing too slowly. And to be fair, they've done pretty badly over the last 5 years. Mm-hmm. But like I don't care. I'll still take them on because like when things go to shit, like those are the companies you really kind of rely on.
Yeah,
right?
yeah.
And
so that's where you draw the line in your risk tolerance.
Yeah.
Okay. Fair enough. Cool.
Yeah. And again, it varies for people, right? So when people are like, oh, like what's your favorite position, or like what's like if I were to like put more money into something now, like I hate that question because like it's
why
it's just because my approach is all like it's now more portfolio strategy focused, right?
Right.
So I don't really have favorite positions. Like if a position makes sense in the context of my portfolio, I'll take it on. If it doesn't, I won't,
okay.
Right?
So you're looking at the whole basket.
Yeah.
Not the one egg.
I think it's a very interesting way because like I think as you grow as an investor, first you're looking for a position that would just make money, right?
Right.
Like that's like a lot of people like don't even make money in the market, so.
Yeah, that's true.
Right, so you have to keep that in mind, and like so they're just happy to make money, and then like eventually you get to a point where you realize which companies are good and which ones aren't. So it's not about finding companies that will make money. Like you can do that. It's finding companies that make money, and will also make sense in the context of your portfolio and what you're trying to achieve.
Right.
And that's a very big difference.
Fair enough.
So sometimes like back going to that one company, Spark Therapeutics, that got bought out last year, I think they were going up to like maybe $90 a share or something, right? And they had a incoming clinical trial readout in hemophilia A, which is probably their key asset, or it is a key asset.
Right.
And just based on what we had seen, we're like, this is probably not, it's likely to go poorly, right?
Right.
And I'm like, well, based on my biases, I'm a long-term investor, and I'm trying to increase my correlation, because if I sell my holdings in Spark and the results are good, my gap between my benchmark is going to decrease massively, right?
Right.
And I don't want that. So I'm like, I'm willing to take the hit even if the trial goes poorly.
Right. Okay.
And it did go poorly. Like the yeah, the drug, so the stock dropped like 40% or something, right? Of course, in the end, it all worked out. But like that's kind of the thing where I'm like, well, if you're trying to you're trying to avoid your downside completely, you should be hedging, or you should be selling out your positions, right?
Right. Okay.
So that's why like you don't necessarily want to follow what the next person is doing, because like especially if they're extremely experienced, because how they're thinking and their portfolio strategy is likely completely different from yours.
Right.
So like I think the 13F filings, right, by companies. Every quarter you kind of see, or by hedge funds you see what they're holding, right? People are like, oh, like they bought into this company, or they I don't really care. I don't really follow that, and it's for the same reasoning, right? You don't really know exactly what their strategy is,
right? So it's not as straightforward as just like picking out a company, because you have what you're saying is you have to look in the context of what each portfolio is trying to accomplish.
Yeah, and like I think as like an individual, like retail trader, like you have to be able to figure out like what your strategy is, and like what your what you're trying to achieve, really, right? And then you will build a portfolio based on that.
So is it dumb to say that isn't the goal just for stocks to go up and make money?
It is. Yeah. But again, like
going back as being like the dumb investor that people ask you these questions, like what's the best stock to buy and all that stuff. They're just looking at it like, how do I buy at A and sell at B, and B being greater than A?
Yeah.
But isn't that right? So, but that's sort of still the goal of your portfolio, right?
Yep. But you're like, but as you I think if you can find those companies, it becomes more of a sense of portfolio strategy.
Okay.
So people have to really understand the risk tolerance, because like a lot of people come in, especially to biotechnology, and they don't really understand their risk tolerance, or they greatly overestimate it.
Right. Okay. So a big part of it is the risk tolerance. Okay. Go
ahead. And then they get absolutely like just slaughtered. Right.
Then do they panic sell, and then that's it?
Yeah.
And then they tell all these war stories about biotech and how they lost all this money.
No, basically, like it's like they're people like they're taking just massive positions, and like small mid cap companies. Like I would never even like entertain doing. I wouldn't be able to sleep.
So they are not understanding the risk tolerance,
or
they're getting
they
into,
might be, or they might be, they might not be, or they might be overestimating their own.
Yeah, I was gonna say
risk tolerance, right?
I was gonna say it's two things. A, they think they know the risk of that stock, which they don't know that well, or whatever their portfolio is.
Yeah.
And B, they don't realize how much they can't handle the risk.
Yeah, I know some people that they're very smart people, and like and they have very high risk tolerance, and their research is like exceptional, and they understand like the inherent risk in any particular position, right?
Right.
So this one company, Ascendus, this one hedge fund, Raw Capital, was like 18% of their portfolio, which is insane. But the stock or the clinical trial results were very strong, and it dropped like 70% or something, right?
After the clinical trial was good?
Yeah. Or sorry, it jumped, not dropped.
Oh, jumped. Okay, sorry. Go ahead.
So if you had 18% and you made 70%, that's I don't know. Can't really do math right now. I'm kind of
divide by 5. Yeah.
Yeah, it's something like 12% or something. It's a big jump for your portfolio.
Right.
And if you're have very high risk tolerance, and like you're comfortable taking that on, I know people who did. Like you made a killing.
Right.
And I didn't have a position in that company. It was interesting because I was familiar with this company enough to know that if this drug it was a non-inferiority trial, right? So they wanted their once a week dosing a hormone growth drug, basically,
right,
to not be inferior to the once daily, what's already in the market, right? And we knew this trial was going to read out, in the next like month or so, and then read out, I think, like 2 months ago, and not only was it non-inferior, it was actually superior. So I was like, holy crap, like this is a big deal, right?
Yeah.
Because like that market is like worth like a couple billion or $3 billion.
Right.
So like I was looking, at the shares like pre-market, and went up from like 65 to like the low 100s, like $104 a share, and I'm like I think it's still undervalued, $104 a share, right?
Right.
Because people were like, oh, wait for it to like bounce. I'm like, no, I think it's undervalued. So I bought shares pre-market at 104. It closed that same day at like 125 or something.
Right. Okay.
Now it's 128. So maybe that's another thing we should touch on. I guess it's like all the behavioral biases, right?
Right. Okay.
Because people think stocks go down, they must go up. And stocks go up, they must go down, right? And generally,
I'm following, yes.
And generally, that's pretty true. But like, there's enough exclusions that you have to be able to differentiate between them, because a lot of stocks keep on going up, and if you short them, you're dead.
Yeah.
Like
some
a
stocks,
lot of stocks
go down,
especially in biotech. If you keep buying it and you try to buy the bounce, like you're dead as well, right?
Right. Okay.
So you have to be able to like differentiate between reversion to the mean bias and what's fear of missing out, I guess, right? When a drug triples on a clinical trial, but you're like, these shares are still undervalued.
Yeah.
And then you're like, you don't wait for the you don't need to wait for the pullback. You just buy shares. And
right. So you're kind of trying to avoid general investing biases.
Yeah,
like where things seem to need to fluctuate, but you could be in a scenario where you're always going way up or always going way down.
Yeah, like I think it's like so crucial for people to understand. If you're not going to do ETF investing, you're going to do your own individual companies. Like you have to understand all these behavioral biases.
Right. Okay.
Because don't get me wrong, you can do well without learning about them.
Yeah.
But I don't know why you would ever not learn about them, because they're very simple to pick up on and read about. Like you can cover all the main behavioral biases in a few hours of reading, and like you think about how that relates to your own thinking, right? Another favorite one of mine is like loss aversion, and it's especially big now in the last 2 years, because 2018 was pretty rocky, right? And
just in general, or for biotech?
Everything.
Yes, it was.
2018 was pretty gnarly. And last 3 months,
so gnarly.
Like, last 3 months,
all my money gone.
Everyone's just getting wrecked, right?
Yeah,
that's just short. Then then you're doing pretty well. And then like I think around Boxing Day, like the market's just like it's basically V. They just like rallied up, right?
Yeah.
And nobody says a word when like they're like making money hand over fist, right?
Yeah.
And then like I think a couple of weeks ago, like the FDA commissioner resigned, and he was really well liked. So like the biotechs dropped maybe like 4 or 5%. People are like losing their minds, right?
Okay.
I'm like, you gotta be kidding me, right? And then like of course like rebounded again this week. But the thing with loss aversion, the bias is people feel proportionally more pain for X amount of loss than they do pleasure for X amount of gain, right? If you're up 10%, you're like, oh, like
that's cool.
yeah. If you're down 10%, you're like freaking the fuck out.
Right. Okay.
So like, and like it's actually really interesting going on like social media and Twitter and like seeing all these people's reactions because they're kind of falling prey to their biases, right?
So so you're saying people, well, just because they freak out might not change their investment though. How would that affect people's investment strategy incorrectly with the bias? Like, are people selling when they shouldn't sell?
Yeah, basically, right?
Okay.
Or they're buying when they shouldn't buy. Basically, long story short.
Right. Okay. So just because a stock is down doesn't mean it's coming back.
Yeah.
Scenarios like that.
Yeah. You have to remember, like a stock that's down 99%, it's went down 50%, then 50%, then 50%, then 50%, like, right?
Yeah. It's been trending that way.
Yeah. Like, and if you try to like, buy the dip, like BTFD, like buy the fucking dip or whatever.
What's that?
Have you heard that?
No.
Oh, it's like just like this meme since like 2012. Every time the market goes down, you're like BTFD, buy the fucking dip, and it goes back up, right?
Right. Okay.
And it'll work until it doesn't. But
well, it's been working for a long time.
Yeah.
General market trends.
Well, actually, even on that note, like 2018, like those last 2 quarters, like when it started dipping, they're like, oh, buy the dip, and then it just went really down.
Until if you bought everything in December, you were okay, I think.
But I feel like if you timed that perfectly,
but not on the way down, probably.
No.
Yeah, fair enough. Cool. So, is this something that you see yourself doing for your whole life? Like, does this really interest you?
It's something that I think
you seem knowledgeable about it.
Yeah, like I would consider myself fairly proficient at it.
Right.
Much more proficient than I am as an engineer.
So you're more proficient in this than your day job.
I'd say so. Yeah. And I have a professional designation.
Hey, that's good.
We all do, yeah.
We all do, yeah. That's right. So would you ever want to jump the fence and?
Yeah, like
because it doesn't like. Sorry to cut you off, but you're not doing. It seems like you have long-term holdings, so there's no day trading aspect to it, or
No.
is there? Because
There isn't.
What I'm trying to lead into is like, could you swap over to do this for a day job? But if you're just doing long-term holdings, your day job would be pretty boring because
yeah.
Yeah.
There's a joke I heard a few months ago. I thought it was hilarious. I never even heard it before. It's like, why do long only fund managers not look out the window in the morning?
Okay, got it.
And the answer is like, because then they have nothing to do in the afternoon. And I thought it was hilarious, right?
That's a good investing joke.
I instantly relate.
Yeah, that's real funny. Yeah.
I think a lot of like what buy side analysts do, like those are the actual professional analysts, right? They're going to conferences, they're interviewing management,
right?
And they're doing their own research, and they're looking through all the sell side notes and.
Yeah.
I think I'd be interested in taking that on. But.
So you might do that or consider doing that for your day job.
Yeah, like I'd have to. I think Calgary is maybe not a really good scene for that. So I think maybe Toronto, Vancouver may have more hubs, but definitely.
So when you say, sorry to cut you off, Calgary is not a good scene for that. My perception when he says is that doesn't make sense because you can trade online. Like,
sorry,
what do you mean by
I'm sorry. I meant in the context of actually finding like a buy side analyst job
Oh.
for biotech. Because
for
biotech,
the actual job.
Yeah, because
okay.
biotechnology generally is much more. It's very state centric, right?
Right. Okay.
So if you were like in New York or California or, like San Diego, oh yeah, I would have like quit my job like a long time ago.
Yeah.
Yeah.
Because that's where most of this is happening. Okay.
Yeah.
So would you consider moving down there?
Yeah, if I got a offer I liked, like I entertain it for sure.
So what would your like if you had a job in that field, what would it be? Because
it'd be basically like I would ideally want to be a buy side analyst.
Oh, okay.
Which is because that's pretty close to what buy side analysts are pretty much like the analysts that kind of like they take all the sell side research notes, right, and then they kind of they basically do their own analysis and to see like what's appropriate for like their funds holdings and stuff, right?
Right.
So there's a big aspect of like portfolio management there as well.
Okay.
Like portfolio strategy.
So what you're doing now, but just on a corporate level.
Yeah.
Okay.
On a professional level.
Right.
Yeah.
Cool. Interesting. So this stuff really got a hold of you over the last 5 years.
Yeah. Well, just one day I realized I'm like, oh, I actually kind of know what I'm doing.
Yeah, I guess if things are going up,
if
things are black, not red, then it seems like you're doing the right thing.
Yeah, and actually, like, when I wasn't as good, and I was like reading like all these like research notes, right? But I was still like decent at this point. But I was reading like all these like reports and stuff from sell-siders and whatnot, and I'd be like, well, this doesn't seem right because they've omitted this key fact or they're wrong for this reason, right? And I actually think that's where I began to build more confidence as an investor. I'm like, you know what? Screw this. I'm not gonna look at their research. I'm just gonna do my own, right? I can do a better job.
Right. Okay.
And I just kind of never looked back really.
Okay. So you felt like in that moment, you felt like you had a knack for it.
Yeah.
And obviously, it's proven to work because you've been picking the right company. So
yeah.
Cool. So should I sell all my boring ETFs and be a biotech investor?
No, I don't think so. It's all actually on that note. Like, I think ETFs are like one of the best things ever.
Right.
People think.
Thank you.
Yeah. No, I agree. Like ETFs, like there's two aspects of ETFs. One of them is like the very low cost, right, which has been touched on. Like that's the whole reason you do ETFs as opposed to mutual funds, right?
100%. Yeah.
Those low fees will really make a difference in the long term.
Yeah.
But the other aspect that I think is equally, if not more important, is actually the inherent risk management and portfolio strategy behind them.
Okay.
Right, because these ETFs are, they're managed by professional investors and they're being rebalanced behind the scenes in the way that fits the fund's objective, I guess, right? And again, the average investor can just not be trusted to do that.
Right.
Absolutely not.
So it goes back to what you're saying before about people not having the correct risk tolerance or risk awareness investing in biotech themselves.
Yeah.
If you buy ETFs, you nullify that.
Yeah, and there's a biotech ETF, right? There's plenty of biotech ETFs.
Right.
And there's one that's there's the two most popular ones, IBB. Mm-hmm. That one's large cap weighted, and I don't really like that one because, again, like it's very if you have a large cap weighted ETF, you're putting a lot of faith in the managers of those large cap companies do the right thing, right? And,
like you mentioned before.
And they haven't, right? So generally speaking, they haven't. So it hasn't done that well over the last 5 years.
Oh, okay.
And the other one, XBI, it's a equal weighted portfolio or fund with like maybe 130 companies. But just because there's so much more small caps than large caps, it effectively ends up being a small mid cap, ETF. And that one I don't really like either because you don't really have the stability from a large cap companies because they're such a small percentage of the fund.
Right.
And when your stretch is so thin and you're exposed to companies that like I don't want to be exposed to.
Right.
And like the position sizes are so small that like you don't really get the outsized effect from like a big multi-bagger, I guess, right?
Right.
A company that goes up 5x, 10x or whatever.
Right.
And so my favorite one is actually FBT, which is not quite as well known as the other three, but it's much more concentrated. It has 30 positions as opposed to over 100. And that one's focused on large and mid cap, which is very close to essentially what I'm doing.
Right.
Before,
Okay.
Right. So if I were to, I think 5 years ago when people were like looking at those ETFs, I'm like, I go with FBT. Like I think it's going to outperform these other two.
Right. Right.
And it did, right? And looking forward, I still think FBT will outperform. Again, it's based on portfolio strategy, right? I think the strategy is just blatantly superior than the other one, so it should, in my opinion, do better than the other two ETFs.
So what's its performance? What's FBT's performance been the last 5 years for each year? Like on average, do you know?
Last 5 years, I think it's probably been about 12%
a year.
Yeah, you have to keep in mind that the last 5 years have been extremely actually challenging for biotech, right?
We got it right here. Yeah, I can see the challenges.
What's this?
This is
nice.
See,
so much challenge.
As a casual investor, this would scare the bejeebus out of me. I see what you're saying about risk tolerance.
Yeah.
Yeah.
So I think I looked at this.
Oh my goodness.
I think I analyzed at 12%, which is, but obviously the risk metrics are like just off the chart, right?
I was gonna say 12%, but that's like so much variance.
Yeah. So the last 5 years have been extremely difficult for like a biotech investor.
Yeah.
So like, it's good though, because like if you can't. If everything's just going up, then you don't really know if you're skilled or not.
Yeah, yeah, exactly. Yeah. Like
right?
in the early tech days when you could buy any tech stock and it was going up.
Yeah. Like everyone's a genius in the bull market kind of thing, but like you kind of have these variations. And I think the last 5 years I've probably done about like 24% annualized.
Oh, really?
Yeah. So I've beaten the benchmarks by a pretty clean margin.
That's really good. That is really good. I think I'm at like 4%. Annualized, guys. So yeah,
you're being
compounds.
You're being inflation,
and that's not including my dividend payouts. So
hey, those dividend payouts could be like a big factor based on.
I have really low risk tolerance.
Yeah,
like when the market goes down 1%, I'm panicking. Not panicking, but I'm like rats.
That's funny because like
I couldn't do what you do is what I'm trying to say.
Yeah, like it's funny because I remember like back in 2010 or something when like me and Pardell were just gambling in the stock market.
Yeah, like
getting crushed.
You guys were playing Russian roulette out there. Like,
yeah.
I was like, I don't want to do that.
And like, and then even Mike got into it too, right?
Yeah.
But I was like talking to Mike maybe a few months ago, and he's like, "Yeah, Michael." He's like, "I just don't like losing money. It's just not cool."
Yeah.
So, because I remember like when like, man, Mike has so many good one-liners, but I remember like, I think near graduation, he's like, "I just want like ball." Is that too much to ask for?
I just want a ball.
Yeah. And then like now you kind of realize like you can Mike does pretty well for himself. Like you can like be aggressive if you want, but it just depends how much risk you want to take on, right?
Yeah. Well, I guess in your case, like you seems like you have a reasonable risk tolerance, but you're also young, right? Like, long-term outlook of you're investing, like you can take the risks now, right?
Yeah, but you have to think about the opposite side of that. If I graduated, when I was 22 and done very poorly, right? That's a lot of lost time opportunity over the years to make up. So you're right that you can take on more risk when you're younger because you theoretically have more time to make up for it. But those early years make a big difference, right?
I guess if you're things are going up, that's more opportunity to reinvest.
Yeah, that's the big thing with opportunity cost too, right? People will be like, oh, like I can't sell this company, right?
Yes.
That's when they're in trouble because you're like, not only are you like, you're obviously all your attention's focused on this one company.
Yes.
You're probably overweight and just getting wrecked, and you're missing out all these other ample opportunities. Right?
Yes, I had this conversation with someone very close to me about how just waiting for the stock to come back up doesn't always make sense because of the opportunity lost on that money.
Yeah.
So
like there's
whoa, can we hold on and talk about that?
Well, the way I look at it, and Wilson, correct me if I'm wrong, but if a stock is down, let's say you bought it $30 down to 20.
Yep.
And you're like, when it gets back to 30, I'm going to sell, so that, and all signs point that to at some point it will come back, right? Like
sure, if you have reasonable,
like CNRL, right, where it's not there's less risk, right, and the odds are it'll rebound, right?
Yeah.
So with that in mind, you don't know when it's going to come back up to $30, but it will at some point.
Yeah, if you have a reasonable belief.
Right. So let's say it takes 10 years.
Yeah.
So after 10 years, you made $0 and you lost $0, right?
Yeah.
On paper. But you lost 10 years of investment opportunity.
Yeah. Also, that's also inflation. So
yeah, like lots of there's losses all over the place. Yeah. So does that make, am I analyzing that correctly?
Yeah, you have to be able to see the opportunity cost. Like so like there's one company IP'd out back in August and last year, and obviously it was like they're doing like NMDA, like it's basically like just in neuropathic pain, right? Mm-hmm. NMDA modulators. I knew like this whole mechanism was like super iffy and super speculative, but I'm like the upside is massive if it works, right?
Right.
So I bought into the IPO at like $18 a share, and then I probably should have done more research because this guy on Twitter that I know is really smart. He actually has his PhD, and he's like doing all this, like he's going through all the preclinical stuff. He's like this drug does not work, right? And I'm like, or it's almost certainly going to fail. I'm like, I should probably like look into this. But I'm like, well, this drug result or this trial is supposed to be released in the first half, and usually when companies say first half, they mean the second quarter. So I'm like, I have plenty of time to like do my research.
Yeah.
Sure enough, the next morning, like the results come out, and it bombed like massively, right?
What? Give me numbers. I want to feel the pain.
Oh, I think it was down like 70%.
Oh, nice.
And then I'm like, well, that's not good. And they're trying getting like fibromyalgia, which is obviously a big opportunity. I'm like, well, like there's a very slight chance it will work, but like I'm not gonna hang my head on it, right? Yeah. So like I'm probably gonna have to take this loss. And then this company was actually spun out by Allergan, by this other company called Norix that was bought by Allergan, and they're doing the same kind of mechanism, but that was in depression, right?
Right.
And that drug or that trial failed massively,
right?
Last week, right, or something like that. So that's when like it's over, right? Like you're done. So like, I sold my shares like right away the next day. So I took that 70% loss like a man. But again, right, I knew that company was like super speculative. So like, when I sized it was like 0.6% of my portfolio, right? So it wasn't a big deal.
Yeah, and then you took the loss, and that's the risk tolerance you had for your portfolio, and you move on.
Yep.
You're not holding and praying.
Yeah, like most people like just can't take losses, and like especially like if you're in biotech, like you can't take losses. Like
it's not for you.
You're gonna take like the biggest like loss of all time, like sometime in your future.
Second only to Bitcoin. No, I'm just kidding.
Yeah.
This is a side note. Did you buy any Bitcoin on the bubble of all bubbles?
No.
Okay, so I just was curious. I wanted to hear a war story there, maybe.
Well, actually, like one of my coworkers, first time I heard about Bitcoin was something like in 2012, I think, or 2013. Like one of my co-ops was like, "Hey, have you? What do you think about Bitcoin?" I'm like, "I don't know. It seems like a pretty bad idea, right?" And it was like that's something like $1,000 a coin. And then like I think he did buy some, and it went down to like 200. I'm like, "Oh, I guess I was right." And then like it went up to like
it was like 10 grand,
and then it started going back up. And I remember like fast forward 2016. One of my coworkers, she's like, "Oh, what do you think about Bitcoin?" I'm like, "Oh, I don't know," like, because she's pretty like hippie and like kind of F the system kind of thing. So I'm like, "Yeah, if that floats your boat, go for it, right? If you can handle the risk." And she bought some at like 2,000, and then like that's like right when like it just like skyrocketed. I'm like, "Well, guess I should have listened to Aveline," and then now it's back down to 4,000, whatever it is.
Yeah, it was a huge bubble. Yeah.
So who knows? Maybe there's. I don't really follow the whole thing that closely.
So you're not a cryptocurrency investor?
No, like I remember like watching a documentary on blockchain, and at the end of it, I still didn't really understand what's going on.
So, yeah, it's like, a tough one.
It's a tough one. Yeah. Like, I'm sure there's applications, but and let's get like all the people are definitely in it for like the quick buck kind of thing, right?
Yeah, exactly. That's the majority, I think, of the motivation of the casual investor in Bitcoin is like buy today, it doubles tomorrow. Right?
Yeah, and I think that like, I could be mistaken here, but like I think if you want this kind of technology or this currency, I guess, to kind of replace the dollar, but you're not spending it because you're hodling it in the hopes that it will like go up, then it doesn't really make sense to me.
I see what you're saying.
Yeah,
it's not actually being traded. Who's acting as a currency?
Yeah, like who's actually like using like Bitcoin to buy stuff or any cryptocurrency to buy stuff that I know of? I know.
I think
I do.
Oh, okay. Well, never mind.
I think Thomas has bought stuff with Bitcoin, but
let's go. Like, how is it pretty flawless or seamless? I guess.
Yeah, it's pretty easy.
Okay.
Yeah,
it's just like digitally sending someone money.
Yeah.
Yeah. So I did sell Bitcoin or buy and sell Bitcoin during the bubble of all bubbles.
Nice.
But since I have a low risk tolerance, as soon as it went up, well, that was a lot in my opinion. I sold it because like my investment strategy is, I'm perceiving a certain amount of return.
Yeah,
and
for sure.
And try not to get greedy.
Yeah.
So then after I sold it, I watched it just skyrocket like a SpaceX Falcon 9, and I was like,
SpaceX Falcon 9.
And then after the few weeks, it crashed below what I sold it at. So it did work out. But
but those few weeks spots like just going parabolic. You're like, oh, what have I done?
Yeah. But that exposes my risk tolerance. Is that
for sure.
I don't have that in me, right? To keep holding.
And like even with something like cryptocurrency, like I would, even though I have a high risk tolerance, I guess like I would just not be able to buy into that without doing extensive research. Because I have to know what I'm buying into, and like I just can't figure out that whole cryptocurrency, so I just would never do it. But
it is a good system. I think I understand it.
Yeah.
And I think it's a better technology than we have now, but I don't know if it's going to be adopted. I think it's a better, I think tech-wise it's a better solution.
Yep.
But it's hard to replace a country's currency, right? Like that's been around.
Yeah, like I could be wrong about this, but I'm pretty sure like every country's like debt is like denominated like in no, they're dollars, right?
Yeah, exactly.
So
yeah.
like how that's.
Yeah.
Yeah, I don't think that's gonna fly.
But it does work really well. Like it's instant and it's untraceable, and it is a pretty interesting way of trading currency. So
yeah.
But anyways, that was just a side note. I was wondering if you went into the Mayday of Bitcoin, but
yeah,
you had enough risk issues with biotech, I'm sure.
Yeah.
Cool. Yeah, that's interesting. So basically, don't do what you do because it's painful, but it seems like you know what you're doing. And yeah, that's fascinating. So I'm probably never going to try biotech because after this conversation, it seems like I couldn't handle the risk, but it's still interesting.
Yeah.
And it seems like you also have a pretty good grasp on the actual products too, which is really important, obviously, and is a must-have. Like this barrier to entry is huge, right?
Yeah, and I think people ask like how. Actually, it's pretty interesting. Like some person on Twitter like asked me a while ago, was like, why would you if you had confidence in a position, why would you only put in less than 1%?
Yeah,
and you think analysts can cover more than 50 companies, and I'm like I know they can, because I've looked at over probably close to 100 companies by now, and obviously 44 the ones I hold I'm pretty familiar with, right?
Yeah. You were saying, why wouldn't they put in more than 1%?
Oh yeah, and that's the whole risk tolerance thing, or how if you're going for a Hail Mary, do you really need to put in 5-10%?
Right.
Maybe not, right? Especially if it's extremely high risk.
So you're saying if companies are fairly certain that something's going to work out, why not throw in 50%? Like that's what a simple investor would consider. Like why not just
they a lot of people just based on their invest based on their what's the word I'm looking for?
Emotions?
Convictions, right?
Okay.
Conviction, right? Like I have very high, hope that this will work out, or believe that this will work out. So we'll concentrate this position, which is not necessarily something you want to do. Especially
right. So you still have to go back to the same thing you did before. What's the risk? What am I willing to gain?
And I think as an analyst, breadth is one of the most important things, because you have to see you have to understand the competition, and just by doing that, you'll be able to analyze so many companies, right?
Right.
And people were like, how can you track all these companies? I'm like, well, you have those you probably know if someone who is big into sports like hockey or golf, and they know every pro stats.
Yeah.
Or cars, it's not really any different, right? You're familiar with all these companies and their key assets. It's and if you have breadth and you can see all these companies and track where they're going, then it becomes almost second nature, I guess.
Yeah, it becomes something. It becomes a skill, or it becomes something that you become very familiar with. Yeah. No, I think that sports comparison makes sense.
Yeah.
If you're really into something, you're gonna know a lot about it.
Yeah.
Right?
So when people say you can't track more than no analyst can track more than 10 companies, I'm like, that's not true.
Right.
You may not be able to know them very every single detail, but you can even easily track many companies and know them to a degree that if it's makes sense to you as an investor to buy or sell.
Yeah.
For sure. Yeah.
Yeah, just like a hockey fan could know details about every team in the league.
Yeah.
If you're into the sport greatly, that's for sure doable, right?
Yeah.
Same for you with all these companies.
Yeah.
Cool.
Are you in any hockey pools or anything?
I don't follow hockey at all, really.
Oh.
Yeah, sorry.
Yeah.
I know that always just takes the conversation to a screeching halt. Everyone's like, what's wrong with you? But that's the truth.
Well, it's funny because I'm in a pool and I'm in the semifinals right now.
Oh yeah.
Yeah, and if I obviously if I win that but it's funny
So what's your risk tolerance on your hockey pool? Have you done that analysis?
I'm just gonna lose everything.
Okay, so you're tolerant of that risk. Fair enough.
But actually, I won 2 years ago. And this year, I didn't know this actually, but they, instead of just everyone put in cash, but then I guess I wasn't following closely, so they put into Aurora Cannabis stock.
Oh, really?
So now there's an option at the end for the winners, do you want to cash out, or do you want to hold shares in Aurora Cannabis?
They took all the money and put it into Aurora Cannabis?
Yeah.
That's hilarious.
So I've decided if I win, I want those shares in Aurora Cannabis.
Interesting. So you're in the semis. Is that the one you're in the semis for?
I'm in the semifinals right now.
Oh,
yeah.
Okay.
It's
Cool.
the playoff round's like 2 weeks, so
Okay.
I don't know next Sunday if I made it to the next round.
Interesting.
Yeah.
Cool. Anything else you want to add?
No, I think that we covered a pretty good breadth of topics, I guess.
Yeah.
Is there anything else you want to touch on?
No, I find it interesting. Like, I don't know, the amount of knowledge you have to have. It seems you have to spend a lot of time on it. It seems like you did that. No, I think from my point of view, investing for me has always been low risk, and I don't want to involve myself. And that's what you mentioned about ETFs, right? Like behind the scenes, that risk is all managed. Yeah. And that's what I want. I don't find investing as interesting as others, and so I go with the more casual, low risk approach. But I still find it interesting to hear about what other people do for their portfolios. And
for sure.
So no extra questions besides how do you handle all the risk? But it seems like you just do it really well, and you just take your losses when you can. But it seems like you've been performing well year over year. So. Cool. Well, appreciate your insight, Wilson. And
thanks, man.
And I think that'll be it. Unless, Thomas, you have any investing questions, I don't want to cut you off.
Nope, I'm hungover.
Everyone's going back to St. Patty's celebrations.
Yeah, exactly. Cool. Well, thanks for coming, Wilson.
Yeah,
Happy St. Patrick's Day, everyone, and to the 3 people that are going to listen to this.
And thank you to our sponsors.
Oh, yeah, which is just booze.
Yeah, booze.
Our sponsor is booze. Cool. Thanks.
All right. Awesome. Thanks.